your weekly digest of the biggest market stories from the past week. Join host Serin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hi, my name's Serin. I'm Director of Listings Fulfillment with the Canadian Securities Exchange. You're joining us for yet another market recap here on Friday, February 10th, 2023. I'm, of course, joined by my wonderful co-host, Bruce Campbell with StoneCastle Investment Management. Thank you for joining me, Bruce.
Yeah, it's good to be back. We took a few weeks off.
We did take a few weeks off. We're going to talk about that later. There's a reason why we weren't able to do our weekly update, and which means we also have so much to talk about today. So we're going to jump right into it. We're going to talk about job growth data that was revealed, which was apparently a bit surprising. We're going to talk about AAII positive. You're going to tell us what that is. We're going to talk about ETF outflows. We're going to get into market moves on earnings. There's a bunch of earnings released. We're going to talk about those. And we're going to talk about early bull and late bear, what that means. And then, of course, we're going to get into some CSC news. So why don't we start with the job growth data? What happened?
Yes, we saw the job growth data released today for Canada, and it was way in excess of expectations. So the number came in at 150,000 new jobs created in January, and the consensus expectation was only 15,000. So it was way in excess of what we were expecting, which is great news. And what we can see here from the chart is that that job growth just continues to grow month over month, and it's been fantastic. With all the talk of inflation, one of the things that that we've seen and been concerned about is the consumer. That's really hit the consumer hard. And we saw last year consumer sentiment fall and was hitting extremes to the downside. And now we've started to see consumer sentiment pick up a bit. And we're wondering if, this consumer sentiment shift is a bit of a function of what we're seeing with the job growth. If you're starting to see job growth and you're seeing people get back to work who haven't been at work for a while, if now they're looking at their outlook in the future and saying, we've got a little bit better opportunities than we had, say, 6 months ago.
Okay, so let me ask you this: job growth data, does that mean new job creation, or does it mean new jobs that have been filled?
Yeah, so those were 150,000 new jobs that were, I guess, created and filled, right? So those were postings that were out there that people, or maybe not postings, but they were new jobs that that new employees started in somewhere new. I haven't seen the data on how many part-time versus full-time there was. I know the US data came out last week, and that was one of the things that I thought a lot of people missed, was that there was an awful lot of it part-time employment, and the market has been a little bit concerned about kind of what all this has meant. They're taking a look now, saying, like, with all this job growth, potentially that means that the Fed changes their interest rate policy, where the market was expecting that they would start to pause fairly soon, and that there would be potentially 2 rate cuts by the end, in the last part of the year, last quarter. Now those have pretty much disappeared, because with the employment numbers being so strong, there's certainly wage growth inflation that the market's now concerned about.
Right. And just to touch on your point about part-time versus full-time is better for the economy, essentially. People have better paying jobs, they have benefits. It all around is better for the economy, right?
Yeah. And I also saw a commentary that, perhaps some of those part-time jobs were people taking on a second job, or having 2 part-time jobs, or having a full-time job and a part-time job to try to make ends meet. Yeah. That was somebody speculating that I was reading. We don't really know the details of that. I'm sure if you dug far enough into the release, you might be able to get some sort of gleaning of that, but it would be pretty deep down into the reading.
Right. Okay. Well, either way, it's good news that there's 150,000 new jobs in Canada. This is great news, and hopefully continues to be so. Okay, we're going to talk about AAII positive. What does that mean, Bruce?
Yeah, so this is the American Association of Individual Investors, and we've talked about this in the past, and they survey people each week, ask them if they're bearish on the markets, bullish on the markets, or neutral on the markets. And for quite some time now, the bears have been well in excess of the bulls. And this was something that a lot of commentators have talked on. A lot of people have made their forecasts on the fact that with, investors so negative and so, excuse me, thinking that the market was only going to go down, that it would eventually go the other way. And now we've seen it swing, so that this is the first month where we were actually seeing positive bulls over bears in the last year. So it's actually, I think, goes back, it might even be 22 months, I think is where it goes back. And you can see there on the chart, that's exactly what we're seeing. And so when we've seen that in the past, it can mean that, kind of the sentiment gets a little bit blown out to the optimistic side in the real short term, and there's a bit of a pullback. But generally, when you're starting to see that movement, it means that people are starting to move money back into the markets. The one interesting thing about this sentiment indicator is this is just people's perception. So it's not actually what they've done with their portfolios. It's just that they're more bearish or bullish than they were, at a previous time. It doesn't necessarily mean that they put money to work in the market. So that's the one thing that, is kind of always interesting about this, is that we don't know.
Right. I was just going to ask you that. So this is how people feel about the markets, right?
Yes.
So this isn't necessarily their actions, but it is a good indicator of potentially them moving back towards the markets, right?
That's right. And right now there's a tremendous amount of cash that's still sitting on the sidelines. People pulled it out of the markets or have let it accumulate. And the thought is that some of that cash could potentially return back to the equity markets, and that would fuel a move higher.
Absolutely. Okay, let's talk about ETFs. There's outflows. What's happening?
Yeah, so this was kind of interesting data, especially considering, kind of how strong the markets have been so far this year. But, we continue to see ETF outflows, certainly, especially in the US. You can see, if you just look at the chart there, it just shows the amount of money that's been flowing out of ETFs. And this, I guess, goes back to, what we saw through most of last year, which was that, investors were moving their way out of the market, building up cash and building up, guaranteed investment certificates and staying in, much safer areas than the market. And so the net flow of funds is something that we always track, because when we're starting to see positive net flow of funds, it usually is, a good sign for the market. If you kind of look back at this data over, kind of the last 24 months, we did start to see a fairly high net flow of funds in 2021. And then that, of course, reversed. And what the thought is that, that often will has sort of trapped those late investors who flowed money into ETFs at the very end of the move. And then, they're the ones that are selling because the pain just becomes too much as they see their financial statements dropping in value, and they sell down. And we continue to see that.
Okay, so I'm just curious. I'm looking at this chart right now. So the chart is by country, right? So
Yep.
this is the net inflow or outflow of money into an ETF by country, right?
That's correct. Yeah. And you can just see how big the number is for the US.
Yeah, that's an interesting list to look at.
Yeah.
Do you think that this could possibly be, if people are leaving ETFs, it means that they're ready to get more speculative and move into resource, or is it typically just a sign that they're leaving the market?
No, it just means that they still continue to be cautious. So, this is where we talked about, previously with the AII numbers, they're saying that they're more bullish, and yet the fund of flow data is showing that that's not the case.
Money's leaving. That's right. Okay. Well, we'll keep watching that. We're going to talk about some earnings that were released. There were some big earnings released was it this past week? And the market reacted. What happened?
Well, we've seen a lot of, kind of very big earnings that have come out, and for the most part, the market has digested the earnings numbers, both good and bad, fairly well. There's
And
been
don't forget, sorry to interrupt, Bruce, but don't forget, over the past year, we've had some pretty shocking earnings, right? I mean,
oh yeah,
the past 2 years, we've had some doozies of earnings that have come out. So sorry, what happened this week?
And also doozies of earnings to come out, but also doozies of reactions to those earnings coming out.
Yeah,
we've seen a lot of that as well, where you just wouldn't have expected the moves, but in a bear market, even good earnings sometimes cause the stock price to go down. So the two that we thought were really kind of fascinating this week were Uber and Lyft. They both have reported this week, and Uber had better than expected numbers. The stock didn't make a huge move up, but I think it ended up about 5% the day after they reported, which is a pretty decent move. And I think the market was actually down that day. But then Lyft, they reported last night, and the last I looked, the stock was down about 35%. So hard to believe that two companies in the same sector, one goes up, the other one goes down. Today, Uber is being dragged down a little bit by the Lyft numbers, but a lot of what Lyft said was that Uber had been lowering their prices, and so it was pulling business away from Lyft.
Oh, interesting. So I've personally noticed this in my travels recently, that I have found quite often a taxi has been cheaper than Uber sometimes. I don't know. It's, they have the extra cost if it's during a certain time of day or if there's a bunch of traffic. And I've also found in some places that a taxi is faster than Uber. I wonder if they've seen their day in the light. What do you think?
Well, certainly it's been extremely tough on the taxi industry, and they're now competing, right? At one point in time, it was great to be able to pull up your Uber and watch where the driver was on your phone. Well, now you can do that with, a lot of the cab companies are the same way. So they're competing. And of course, if it comes down to just a commodity, like somebody's taking from here to there, price is going to start to matter.
There was a show that was created about the Uber story, and I think it brought light to a lot of what happened with Uber that maybe people didn't realize that could maybe have a part of it as well. Okay, well, good luck, Uber and Lyft. I've never taken a Lyft before. I should try a Lyft. Okay, what does early bull and late bear mean?
So
other than spring in Vancouver.
Yeah, what we've seen is we keep track of stocks and sectors that are specifically early bull market stocks and sectors, and stocks and sectors that are late bear market. And so that's what this chart's showing you here, is that we've seen a bit of a shift in sentiment now from those late bear market stocks. So those tend to be, kind of more the staples, utilities, healthcare type of companies. And then the new bull market tends to be, financials, technology, and discretionary stocks. And so we built our own indexes off of this to be able to track this. And what you can see now is that after a period of about the last year where where those bear market stocks were outperforming the bull market stocks, now you've seen that shift. So along with, what we talked about with the AAII numbers, what we've seen so far with the market returns this year, it looks like, markets are starting to look past, this inflation, potentially the recession, and looking out to see where the next opportunity lies, 6-12 months down the road. And they're looking at, these companies and certainly bidding up the prices of those companies at a faster rate than they are the late stage companies.
I think it's important for people to think about, how much our life is reflected in investing. You look at the late bear and there's consumer staples, healthcare, and utilities. These are necessities in life. And so when the markets are bad, people tend to invest in these safe, or what they feel is, a safe haven to go to, because these are necessities, whether the markets are good or bad. When they're feeling better about things, they move on to, I don't remember all the things on that chart, but I think real estate, financial,
discretionary, technology. Yeah. Yep.
Exactly. And, it really is that simple. So once we move into a place where the economy is doing a bit better, people feel more comfortable moving into something beyond what our necessities are, right?
And they're looking for those earnings too down the road. So, they're looking out and saying that, if we talked about earlier with the consumer sentiment, that number is starting to trend up. So what does that mean? Oh, maybe in a year from now, the consumer is going to be buying more discretionary items, or they're going to be spending more on technology, or, businesses underlying that are going to be doing better. And so they're going to spend more on technology. And so, it's like the cycle of the markets.
Yeah. Yeah, absolutely. Okay, well, this is all fairly good news, Bruce. I like this. After not seeing you for a few weeks, thank you for bringing good news. We're going to talk about some CSE news. I don't have issuer news for you today because Bruce and I have missed a few weeks. There was just so much amazing news out there. You can always go to our website and see all of our issuers' press releases. So if you're intrigued in what's going on with all of our 800 companies, you can always go see day by day what's happening. What I want to talk about is we've had a really big week at the CSE. We have just opened our new Vancouver office. Bruce, you are coming to come and see it. So I'm looking forward to that. I hope we can do a market recap in our new office, in our new podcast studio that James Black put together for us. But we had VRIC. VRIC is the Vancouver Resource Investment Conference. And I think it was probably their most attended conference they've had in several years. So this was really exciting. And you feel the buzz when you're at these conferences of how the markets are doing, and people were excited. You saw deals actually happening on the floor. You saw lots of good energy. So it was really great to have that happen. We've opened our new office in Vancouver. So if anyone's ever in Vancouver, please come by and see us. And we're getting ready for, this Q1 has always traditionally been the mining time of year for the markets. We're getting ready for PDAC and in anticipation of PDAC, which is the Prospectors Development Association Conference, which is held in Toronto the first weekend in March. The CSE has traditionally done a PDAC, which has come back now after the pandemic. And Bruce, you will be joining me at PDAC in Vancouver. Thank you so much for making the trek out. I'm looking forward to having these chats face-to-face in 3D. So we're going to be talking all things mining at our PDAC. It's in Vancouver at the Vancouver Club, February 23rd. You can go to our website to register, and we'll have PDAC in Toronto, March 1st at the Albany Club. And you can, of course, go online and register there. So make sure that you come to the PDAC and find out what's going on in the markets. And then, of course, we'll be at PDAC. Okay, so Bruce, my question for you of the week, what are you thinking about the mining space right now?
Well, it's really interesting. There's been, more financings that we've seen. The stock prices in a lot of areas are improving, and there's some really interesting sectors as well.
Yeah, well, there's a lot going on. Like, we're seeing some really neat stuff in mining technology, rare earth, battery metals, gold is even having some intrigue. I'm hearing lots of deals that are going on in that space. So it seems like it's a buzz.
It sure is. Yeah. Yeah, it is.
Okay. So what should we think about going into next week, Bruce?
Well, I think the big thing that a lot of people, a lot of investors are going to be watching is that CPI release in the US that's going to be coming on Tuesday morning. So we'll get a nice little Valentine's Day gift, or it's not going to be so friendly. We'll find out at 8:30 Eastern time.
Okay, to remind people, CPI is the Consumer Price Index, and this tells us an indication of how much inflation we're dealing with, right?
That's right. It'll be the January inflation data.
So we're hoping that it's smaller than the last one, which encourages the Fed to not raise rates as quickly, which encourages Canadian government to not raise rates as quickly, which means we can run out and, get back in the markets, right?
That's right. Exactly.
I love it. I love it. Listen, Bruce, I've missed you. It's been so great to catch up with you. I look forward to doing it next week. And again, February 23rd, Vancouver Club, Bruce and I will be in person. So come say hi to us if you're around. Thank you, Bruce.